is Tim Goslin. I provide location advice for building owners and occupants, and you are listening to my very first edition of Tim Talks. The purpose of this video is to provide a 2016 commercial real estate market overview and a 2017 projection as to what I see going forward. Let's start with the leasing side of the coin first. The industrial, flex, and retail product types are really strong and have been really strong throughout 2016 and even the past couple of years. Vacancy rates are at all-time lows as far back as I can track them. The office market is also strong. It's healthy. It's not as strong as those other product types, but you're looking at a 10% vacancy factor countywide, so that is a very healthy market. The industrial, flex, and retail markets are in the 4 to 5% vacancy range. So there's just not a lot of product out there right now for occupants, and pricing has gone up dramatically because of that. Let me give a quick example. So in the end of 2010, beginning 2011, I had an industrial flex product about 50% improved that was available in the northern city of San Diego area. At that time, the market was really soft. You had a hard time giving product away. Companies were not very healthy back then. Everyone was in a pinch and we were all hurting. So I put together a marketing plan to fill that space up quickly. We ended up getting a deal done at 60 cents gross year one, 70 cents gross year two, and then 80 cents gross year three, and then we did cost of living bumps after that. So fast forward over the last 6 years, the time horizon, where are we now? That same product type would be leasing out for $1.20 gross per month per year. So the market has changed dramatically. If you're an occupier of space, you have seen your occupancy cost double over that last 6-year time horizon. On the sales and acquisition and disposition side of the equation for buyers and sellers, cap rates right now are between a 4.5% and a 6.5% cap, depending upon product type and credit strength of your tenants. That is an extremely strong market right now. You're not getting a lot of return if you're a buyer right now. But there's plenty of buyers, there's plenty of cash coming in, whether it be from the Asian markets. A lot of people think the stock market is due for a correction, so you've got a lot of money coming in from various factors that have really compressed cap rates down to where they are currently. It's a great time to sell if you've got a multi-tenant project. On the owner-user side of the equation, on a price per foot or a price per pound, however you want to quantify that, the market is as strong right now as it was back in 2006 at the top of the market. For either if you're an investor or you're an owner-user looking to purchase product, same scenario as leasing. There's not a lot of options right now, and because of that, pricing is really aggressive. So what does this mean for 2017? Certainly on the sales side of the coin, if you've got a 3-year exit strategy where you're looking to get out of your portfolio, a building that you own, I believe you want to accelerate that 3-year exit strategy, and you probably want to look to sell sooner rather than later. I don't see this market staying as strong as it is going forward for the long-term foreseeable future. On the leasing side, I think you want to be aggressive because there's not a lot of product out there, but you also want to be realistic. You price your building so high it becomes unaffordable for an occupant to lease out your product or to lease your product. So I look forward to seeing 12 months from now where we ultimately shake out. From a humility standpoint, I'll say my crystal ball is no better than anyone else's, but certainly it's a great time to be a seller right now, and nobody goes broke making a profit. So my advice is take your chips off the table, pay the capital gains if you need to, and just hold on to that money, and there's going to be some buying opportunities to come as we begin to have a correction. With the interest rates continuing to increase for the next, I heard it, as long as the next 6 quarters, we're going to continue to have interest rates increase. You're going to see pressure on cap rates begin to rise as well for a higher return on their investment. And then on the owner user side, every time you see an interest rate increase, that means a buyer's buying power, the amount that they can afford, is going to begin to go down as well. So thank you so very much for tuning in. If you like this video, click the thumbs up or I like it. Please subscribe to my channel. Plan on producing this content quarterly. Have an awesome 2017. Thanks so much. God bless.